Hey everybody, Corey Peterson with Kahuna Concepts. I really want you to pay attention because I'm going to show you how to get this book for absolutely free. My book, Copy Your Way to Success, Standing on the Shoulder of Giants. Not free plus shipping, but truly free. But you got to wait till the end to see how you get it. All right, so today I want to share with you a structure that I believe has revolutionized the game in raising private capital. A lot of people do syndications a lot of different ways, but I think my way makes a lot of sense, and more importantly, it's easy for the investor to understand what they're going to get. So I'm just going to walk you through typically how we try to structure our deals at Kahuna Investments, and so hopefully it makes sense to you. Normally, here's what we do. When we get ready to buy an asset, we're going to create a property LLC. This is the entity that's going to purchase it. It's also the entity that's going to create a PPM, a private placement memorandum. This is the paperwork or the legal part of what we got to do to raise private capital. Now, when we structure this PPM, we generally structure in a way where we have A shares and B shares, okay? Our A shares are our limited partnership shares. These are investors. They are passive investors. They have no voting rights. They give us their money in promise for a return, okay? And it's spelled out what that return is in the PPM, but I'm going to go a little bit in our structure of how we generally structure it, or how I think is a great way to structure deals. Okay. Now, so your A shares, your investors, your B shares, this is where you have your general partnership. A lot of times they call it the GP, and we call it a holding LLC. So we'll create a LLC, and then we'll put our partnerships, the partners in our deal, underneath it. So we could have a couple different partners, A, B, and C. That's a horrible A, by the way. And that's kind of how we have our partnerships in this deal, okay? Now, we elect, and this is more for asset protection, we elect a manager, because there's A shares and B shares. B shares are your voting shares. And as a voting share, we elect a management LLC to be the manager of the property. So this is what actually is going to qualify for your loan. Now, what's cool about this management LLC is it doesn't own any assets. And the reason for that is, let's say someone falls and slips on the third floor, goes over the railing, and dies. Who's going to get sued? The management LLC, which owns no assets. Over here in our holding company, this is where we take our income or profits as an investor, and it's a good way to have some asset protection, okay? So that's that side. And then, of course, this property is only going to own one asset, just the asset, the apartment complex that we're going to buy. So we do it for a PPM, just for the purposeful asset that we're going to buy. Next, we come over here. We typically create 3 share classes of A shares, A-1, A-2, and A-3. So let me go over kind of what that means to us and how we structure these types of deals. So in the A-1, this is normally what we call a 6 and 6, meaning it's a 6% pref. We're going to pay that through cash flow profits of the property. And then upon sale or disposition or refi of the property, we can exercise a call option, or we just sell the asset, and our investors are going to get another 6% annualized for as long as they've had the investment in the deal. So what that really means is a total return annualized of 12%. So people understand what 12% means. So it creates a 6% paycheck, and then at the end, they're going to get another 6% equals 12, okay? And the price break point to get that is our minimum investment, which is $100K. So we feel like If people give you 100K, that's their 6 and 6 entry point. Now, this is what we used to do, and that was the only share class that we had. But we realized we were missing out on repeat investors or investors that had larger tranches of money. So we created 2 more share classes. So in A-2, we created a 6 and 8, right? Same setup, 6% pref as we're going along. But when we sell or on the disposition side, instead of getting 6%, now they get 8 annualized for as long as they keep it. So that makes them a total return of 14% annualized year over year. Okay, so they get more money for the investment. But here's the catch, right? Is they got to give us a minimum investment of $300,000. Okay, so this is going to encourage your investors. After, usually this is what happens. They initially come in, they don't know you, they want to get to know you. They know just enough to give you some initial investment of 100K. After they've been and you're giving them now future deals, they feel more confident. They'll usually want to kind of make more yield, and they're willing to give you more money to get it, right? And then we have one more class, and this is for our guys that are typically bigger, wealthier tranches of capital, and that's our A-3, which usually gets 6 and 10, right? Again, so for everybody understanding this, this is now a 16% annualized return. Now, you can make it 6 and 10, you can make it 6 and 12, you can make all these numbers change, that's up to you. This is a good standard practice that I think makes a lot of sense, and it's really defining the payout. So it doesn't matter, it's not a true like 70-30 split where the investors are always going to get 70-30, like, because that may or may not happen. We're defining our payment in the PPM and discussing how that waterfall falls. I think people like more certainty. So we give them more certainty in the pref and the pref on the sell, so that that's what they get, that's what the investor gets. And then if we do a really good job in creating value for the property, that's our benefit of being the operator or the B-share investor. But this is a very great structure to create a lot of income for your investors and giving them what I think they want, which is a great solid return with great back ends or opportunities on the back end. And they like it more, I think, structured and fixed, so they kind of have a pretty damn good idea on what they're going to yield in that investment. All right, so let me show you how to get the book. All right, here's how you get the book. It's real simple. It's not complicated. This is not free plus shipping. This is absolutely just free. My team will ship you the book, okay? You're going to text the word book, B-O-O-K, book. Text the word book to 480-500-1127. Text the word book to 480-500-1127. Follow the prompts. Give us your address. We'll send you the book for absolutely free. It's a great book. I wrote every word. I hope you guys enjoyed this session. Pay attention next week for another Kahuna Concepts.